Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is February 1st, 2015 edition of Market Outlook. Well, markets certainly have been volatile. Let's take a look at the indices. We'll go through the markets as we usually do. They're at interesting junctures, so we're going to take a look at uh, some of the key indices, volatility, etc. First thing is look at this compression. So you have what I call a high and wide compression, indicating higher volatility. But listen, let's take a look at this. You can see that basically since late July, the market has had pretty much sideways action with lots of volatility. Now, this compression here, the sideways action, um, is sitting right above a couple of key points here. The lower end of the Bollinger Band, the 200-day moving average, and it's sitting, and the 50-day is starting to turn down as well. So if we take out this 200-day moving average, it will have taken out all of this consolidation. So very, very risky. On the other hand, the markets have definitely tested the lower end of this range. You're not quite oversold, certainly not on a relative strength basis. So you definitely have some more downside. What we have to watch for, obviously, is the huge amount of liquidity that the central banks, the ECB, the Fed, Japan, they all have a huge ammunition and war chest to support their markets, and their stated mission is to support these markets. So the question is, how far are they going to let them fall? And so the sideways action here, obviously a breach of that support should yield at least another 5% to 10% correction if we break these levels. And that's simply a count from the low, which is right around here, to about the highs, which is approximately the 210 area or 209. So you have about a 10-point range that would assume at least that type of move to the downside if we break. On the other hand, support can materialize here. If we take a look at the weekly chart, interesting pattern. Let's play with the trend line here, channel line. Obviously, we basically hit the upper end of the channel. There we go. Again, interesting support around that 190 to 192 level, which is still a good 4 or 5% decline, which would also meet the count as well. Looking at the longer term trend in the spiders, you can see on a monthly chart, extremely well intact. And again, this accelerated channel line has definitely kept the market in line here along that. So interesting longer term. Again, we took a parallel from the highs of the channel, the recent channel, and dropped it right down to the low here and the low here. And again, it sort of coincides right around those levels that we talked about at the 192 level. So that is a very critical long-term support level, including this 23-month moving average. That is definitely part of what I would call the liquidity cycle, that measurement. So we're looking at different moving averages in different time frames to measure different types of cycles. And clearly that longer term moving average is sitting at 183, a bit below this trend line. But again, that would be the extreme longer term trend. And with that being breached, that would call the longer term trend in the markets into question. Now, let's take a look at bonds, TLTs. And there's nothing you can say other than the long bond in explosive parabolic move. And when these things are underway, there's just no saying where they can end. Obviously, the flood of money outside or flowing to the U.S. from nations under stress, such as Russia, Greece, and the rest of the Eurozone, certainly questioning the viability of the euro, is definitely pushing U.S. denominated assets much stronger. So bonds strongly in gear, hitting basically new low in yields, new high in prices. Now, what's interesting, even on a daily basis with these TLTs, not overbought. So looking rather strong. This rally can continue. And when you get this type of parabolic move, and you can really get a better perspective on it on a weekly basis, that's fairly parabolic. It can continue. Not saying you can't get a correction. Important support clearly around the old highs, which is about the 131 level. Now, on a weekly basis, we are overbought, but it can remain overbought for quite a period of time. Interestingly enough, if we go back to the daily chart, as I mentioned, you can see we are not as overbought or overbought at all on the relative strength indicator that we have here. Let's take a look at gold. Gold is a very, very interesting chart in setup. We came down, tested the 200-day moving average after a pretty good size move and rejected it, meaning that this overall trend, the 200-day moving average, is looking like it's going to hold as support. Again, that's a critical level to hold. The low from Thursday, important to watch. If we trade under it, it could tell you that the rally in gold is now stalled. But for now, sitting above this 200-day moving average puts this, with the 50-day under the 200, into what we would call a accumulation phase. So that's a definite increase in phase to the upside. Again, if you take a look, we have been sort of on this for a while. The critical point here was gold basically traded through, had a panic bottom late December of 2014, and now we're trading above this critical zone here rather nicely. Now, also to note, this longer term moving average, which is the 65-week moving average, we've traded above it now really for a couple weeks in a row. That's the first time we've seriously taken that out since the beginning of 2013. So that is an important number to hold as well. So that 200-day moving average, the 65-week coinciding as well. So this is a very, very important level to hold. And if we power out of this little flag formation, we can certainly get a rally back up to the 140 level, which would be a potential $170 move in gold bullion. Let's take a look at volatility. This is the spread between 3-month and spot volatility in the options market on equities. Right now, we're sort of in the middle of the range. We had gotten overbought. You got that rally, a little rally off the lows there from 200 to about 205. It stalled. It's now moved under the moving average. And so this is the ratio between the two. Beneath 1 and 1.2 are critical areas to watch. We're not anywhere near those right now, but are coming down and trending down. That is more negative action overall. So volatility more in the negative camp. Let's go back take a look at VIX. And really interesting chart on VIX here. As you can see, we basically held the 200-day moving average. We're trading on the highs. Interesting, going back now for, well over a year or to a year and a half, this is the most sustained movement above the 200-day moving average that we've had in a long time, and the 50-day as well. So aside from the correction in October, where we had that 10% sell-off in the market corresponding with this move, this is more of a pent-up sort of compression. We are touching the top of the Bollinger Band, but this green line up here. But as you can see, the 50-day converging with the 200, so the momentum is starting to turn up here. Let's see what happens at this high of the Bollinger Band. But as you can see, you can get to the top of the Bollinger Band, power through it, and get quite a nasty sell-off as a result. So interesting pattern here. The fact that we've sort of consolidated, moving sort of sideways as we've moved above the 200-day moving average, and actually have held firm, could be a harbinger of another good size move down in the market. So a little bit cautionary with the VIX acting as well as it has here. And again, would reverse and change course with a move under the 50-day moving average. But that would obviously correspond with a, at least a 400 or 500 point move to the upside as well in the Dow, or a substantial 2-3% move to the upside in equities. But that would probably tell you that this sideways movement is being resolved to the upside. Let's take a look at oil. Did some interesting things. USO, U.S. Oil Fund. Friday's action might have been an indication of a blow-off bottom here. You had some really good volume on this particular bar. Again, reversal day here, closed at the top of its range after making a new low, and huge volume to the upside in oil as well, and closing in the upper part of its range and through obviously the highs of the prior day with huge volume. So it looks like you might be in a potential intermediate, or at least a short-term bottoming pattern. I would be looking to buy weakness on this particular chart, and this is definitely quite a bit wrung out. Let's take a look at the monthly chart. You can see it's about as wrung out as it gets. The relative strength indicator on a monthly basis, even with Friday's pretty strong movement at a 0.23. So that definitely coincides with some really long-term bottoms as well. So we want to see this thing turn up, certainly on a monthly basis, but you can see we are in extremely oversold conditions. Now, interesting, let's take a look at the weekly chart. Weekly chart, we've actually hit and turned up. That's the key thing here, because when the RSI is that weak, it can stay weak and collapse, and it did, as you can see, for weeks. But that first turn that's significant here is that potential short-term pattern on a daily chart, extremely oversold on the weekly, is something to keep an eye on. In the interim, with increased hostilities in the Ukraine, Russia under pressure. Let's take a look at the daily chart, RSX. another good chart to watch. Obviously, the political turmoil in the Ukraine leading to further uncertainty, and as Russia gets more and more desperate for its economy, what Putin does is definitely suspect. So as you can see here, we've got sort of a wedge formation. We broke down. Things seemed to quiet down for a day, came back above it, but it failed. Key point here in Russia, and this would probably be a good tell for the markets overall. If we can get above the recent highs and the moving average here, which is about 1650 to 1660 level, that would take out this sideways consolidation and the 50-day moving average, and would probably tell you that tensions are easing up and markets will start to recover. One last thing, taking a look at junk bonds and the oil patch, similar pattern. Look at this, it really has been holding here in a sideways action, and above the 50 and the 10-day moving average, which is now starting to move up. So we've gotten a position here with a relatively tight stop. If oil stabilizes, the possibility for continued pressure on junk bonds will be abated, and you can see maybe a snapback up to the 40 level at a minimum. So let's see how this acts. Obviously, a move down beneath the weekly lows here, going back. You can probably put your stop in under 38.40 or 38.50 for if you're a bit more of a swing trader. If you're looking for more action or tighter risk, obviously moves under the what's the number here? 38.75 would stop you out. So interesting consolidation. Hopefully this is flagging here for a move to the upside, and maybe the pressure on really cheap oil is abated, and that is obviously a concern for the markets, although they're acting a bit schizophrenic in a sense, because even with the rise in oil prices on Friday, markets did not react. So on one hand, you have the fear of deflation. Oil energy prices a big component of that, and oil markets basically roared on Friday, and yet the market sold off. So it's unclear to me as to what the markets are really looking for. All right, well, I hope that helps. See you next week, and we start a new month, and stay frosty because these markets are definitely in play, and stranger things are going to occur as this year unfolds, as all this excess liquidity ends up somewhere, and different bubbles may or may not be burst or formed. And this is, as the world is awash in this central bank liquidity, it's very, very hard to know where it's going to follow. Okay, thanks, and that's Keith Schneider, CEO of MarketGauge.com, signing off. Have a great week trading.